Ever wonder why some beginners seem to struggle with investing? You hear stories of people losing money, panicking during market drops, or buying into trends that crash. Investing can feel exciting, but without the right knowledge, it can also be costly. Today, we're going to cover the most common investment mistakes beginners make, and more importantly, how to avoid them. These tips apply whether you're thinking about stocks, crypto, ETFs, or mutual funds. By the end of this video, you'll know how to invest smarter, protect your money, and grow your wealth over time. The first mistake beginners make is jumping in without a plan. They might invest because a friend suggested it, or because a stock or cryptocurrency is trending. Without a plan, you have no roadmap. You don't know how much to invest, what your goals are, or how much risk you're willing to take. Ask yourself, are you investing for a short-term goal, like buying a car or paying off debt? Or is this long-term, like saving for retirement or financial freedom? Your goal determines your strategy. For example, imagine two friends. Jane invests $200 a month blindly in hot stocks she sees online, while Mike invests the same amount, but with a clear plan, targeting low-cost index funds for retirement. 10 years later, Mike has a more predictable and stable portfolio, while Jane's results are all over the place. Having a plan gives you direction and helps you avoid costly mistakes. Next, emotional investing. Beginners often buy when prices are high because they don't want to miss out, or sell when prices drop because they're afraid. Decisions based on fear or greed rarely work out. The market goes up and down, and trying to time every peak and dip is almost impossible. Instead, adopt a strategy and stick to it. One popular method is dollar-cost averaging, investing a fixed amount regularly, regardless of market highs or lows. Here's an example. Alex bought a cryptocurrency at its all-time high during a hype cycle. A month later, the price fell by 40%. He panicked and sold, locking in his loss. Meanwhile, his friend Maria invested gradually over months using a consistent plan, avoiding panic and benefiting from price fluctuations over time. Emotional investing is one of the fastest ways to lose money and confidence. A steady strategy is far more powerful than chasing highs and reacting to lows. Another common mistake is putting all your eggs in one basket. Beginners often invest everything in a single stock, crypto, or sector because it seems promising. Diversification spreads risk. If one investment drops, others may stay stable or even grow. A diversified portfolio could include stocks, bonds, ETFs, and even some real estate. Think of it like gardening. If you plant only one type of seed and a disease hits, your entire garden could fail. But if you plant a variety, even if one crop fails, others will thrive. The same principle applies to investing. Diversification protects your money and reduces stress. Fees are often overlooked, but they silently reduce your returns. Many beginners don't pay attention to brokerage fees, fund management fees, or transaction costs. Even seemingly small fees compound over time. For instance, a 1% fee on a $10,000 investment might not seem significant, but over 20 years, it could cost thousands in lost growth. Always check fees before investing. Look for low-cost ETFs or index funds. These often outperform expensive active funds and keep more of your money working for you. Remember, every penny saved on fees is money that can grow over time. Beginners often follow trends blindly. They invest in something because it's trending on social media or a friend said it's hot. Always understand what you're investing in. Read the company's fundamentals, know the business model, and check the market potential. Knowledge reduces risk and helps you make better decisions. Here's a story. Sarah invested in a startup everyone hyped online. Within 6 months, the company went bankrupt. She learned the hard way that hype isn't a substitute for research. Doing your homework protects you from costly mistakes and helps you find genuinely valuable opportunities. Some beginners trade too often, trying to chase quick profits. Every buy and sell incurs costs, and constant trading can become stressful and risky. A long-term mindset works far better. Hold investments over time and let compounding do its work. Time in the market beats trying to time the market. Beginners often pick investments too risky for their comfort. High rewards are tempting, but if it keeps you awake at night worrying, it's not worth it. Know your risk tolerance. Younger investors can take on slightly higher risks, but everyone should maintain a balanced approach. Adjust your portfolio so that even if markets drop, you can stay calm and stick to your plan. Let's recap. Have a clear plan. Don't let emotions control decisions. Diversify your investments. Watch out for fees. Do your research. Avoid overtrading. Understand your risk tolerance. Investing is a journey, not a sprint. Mistakes are part of learning, but avoiding these common ones protects your money and peace of mind. Start small, invest consistently, and grow your knowledge along the way. Your future self will thank you for making smart choices today.